Alright, good afternoon now, folks, as we are at the end of another pretty busy week of trading on Friday, the 13th of October. We'll have a look across the calendar, we'll speak across, or have a look across markets and have a look across the calendar, but to begin the week, obviously not good news in relation to some escalation of troubles between the Hamas group and Israel. I don't want to get too kind of into that. Obviously, what's going on over there is terrible, and we hope that they come to some sort of truce at some point. Although that doesn't seem likely, judging off the last kind of 60 odd years that this has been going on. But I don't want to comment too much about the kind of the humanitarian side of it and the history of it. We just got to think about what that means for financial markets. Now, what that does mean, for what that has meant over the course of this week for financial markets, was gaps lower on the equity market. You can see the S&P, the Dow Jones, the Nasdaq, the Russell, they all gapped lower. Stock markets across the board did gap lower at the open to this week. So negativity, a bit of risk-off sentiment, as you would expect with the situation obviously ongoing. You can see across bonds purchased overnight. Opened up a little bit late. US bonds in relation to the bank holiday we saw in the US, but a bit of bonds being purchased off the back of kind of some safe haven flows. The main movers at the open, the main mover at the open, was oil. Any sort of conflict in the Middle East can lead to some fears that production may be cut. Or some, I say production cut, maybe some production, or there's a lack of production, as they are large producers and exporters of oil. So oil popped higher aggressively off the back of that, a good 4.5% gap on the weekend. It says, it does have a candle here, but that is a gap. They just fill it in with the candle on some of these charts on TradingView. That then chopped sideways for a couple of days, and then on Wednesday Saudi Arabia did come out and suggest that any production or any offset in production due to the conflict in the Middle East, they would offset by increasing production themselves in order to help stabilize the oil market. Oil then pushes lower, chops back higher, back lower, and then oil has rallied into today, with the US imposing fresh sanctions on Russian oil, causing a potential for reduced supply, and then reports that oil supplies will diminish over the course of Q4 this year, has sent oil through the roof. Main mover of today was up a good 3-4%, over 4%, has had a bit of a pullback in recent trade off these highs posted back on Monday, but still a super aggressive move in terms of the price of oil. And that was what we were focused on Monday, Tuesday, Wednesday. We did have these minutes on Wednesday which showed the Fed officials were undecided about the rate picture going forward, even though that they did upgrade the dot plot, suggesting that we will get an interest rate hike through to year end. That has not been so clear over the course of this week. The minutes did point that out, but we also did have a speech on Monday from Fed's Jefferson suggesting that interest rates, or the fact that yields are where they are, and the fact that yields have rallied the way they have, may in fact do the job for the Fed without them having to raise interest rates themselves. US 10-year yield being the basis for a lot of loans throughout the US, namely US mortgages mainly, and that then obviously curb spending if yields push higher, so it has the same desired effect, or same effect as would be the desired effect from hiking interest rates. So I'm not sure if we will get another one of them. We then come into GDP from the UK in line with consensus on Thursday should I say, but then Thursday afternoon the big one, CPI, over the course of this week should I say. CPI, we got the headline figure and core CPI. Now core CPI month over month and year over year came in bang in line with expectations. Monthly inflation figures and yearly inflation figures, once you include food and fuel costs, did tick up slightly. I say tick up slightly, but did beat consensus, which increased. It does it kind of fuel or solidify a rate hike into year end? I'm not so sure, but markets have begun to price out an interest rate cut from next year. which is a bit of a hawkish step. Where you saw the dollar rally off the back of that, and then stocks, a little bit of stocks downside off the back of that. You can see Aussie, Kiwi, Euro and Sterling all pushing lower aggressively. You see dollar Swiss, dollar CAD, dollar yen all pushing higher aggressively post CPI yesterday. You saw stocks have a bit of downside yesterday, but this second wave of selling came in last night. They had around 6 o'clock last night, they had further bond issuances, longer dated bonds to be purchased by market participants, which they had a strong lack of demand, a heavy lack of demand, whatever way you want to put it, but a lack of demand for bonds dated, longer dated bonds, should I say. So longer dated bonds struggling to gain any sort of traction, and that then sends yields higher, which we can see across here. Yields continued higher, popped higher off CPI, continued higher into that last night, and increasing yields, higher interest rates, negative for stocks, positive for the dollar, and that is the reaction that you saw in the at the back end of yesterday to kind of further push that CPI print further. So not necessarily all to do with the CPI, a lack of demand for bonds dated further into the future, and that becomes a little bit troublesome for markets going forward. If there's a lack of demand for bonds and yields continue to push higher, well, that is interest rates pushing higher and can have implications across financial markets. Right, we then come into today, but yields have retraced the majority of those moves from yesterday. Yields continue to push lower. Right, we saw gold yesterday push lower off the back of a bit of dollar strength and yields pushing higher. Then we get the pullback in yields, and the gold has just gone through the roof over the course of today as well. Now, you will have had a lot of short positioning built up on this trend the whole way down, especially this aggressive trend the whole way down the kind of last week of September. Super aggressive move down on oil, or gold, should I say. You'll have a lot of short positioning built up, people backing out of shorts, yields then having a pullback. Gold through the highs, and that has just rallied aggressively over the course of today. Massive moves across gold, but it's not really a dollar move. You can see the dollar's just been chopping sideways the majority of the day across all the different currency pairs. So quiet week to begin the week in terms of the US dollar. To begin with, dovish comments from Fed officials, slightly dovish FOMC minutes, did have a bit of US dollar weakness, but then that strength has come back in off the back of a hot CPI and a lack of demand for longer dated bonds. Apart from that, that's really what we've got to go off at the moment. You can see stock indexes just in recent trade having a bit of a pop higher, reversing these moves from yesterday, but they're a little bit unsure as to what they want to do. Markets not really believing that the Fed will hike interest rates again. Stocks rallying off the back of that. Again, there's no interest rate hikes priced in from markets through the year end. Markets think that they are not going to hike interest rates, with inflation only slightly beating consensus. Doesn't really make for a we need to hike interest rates scenario. If interest rates where they're at, they continue to have the effect that it has been having over the course of this year. Hopefully that continues into year end and prices continue to normalize. So we did have CPI out of China this morning, flat, no inflation over the last year in China. Did cause a bit of downside in Asia Pacific equities over the course of last night, but then obviously the European and US equities take center stage as we trade the sessions that we trade. But that's a little bit of a tricky one. Extremely volatile week. Upside on gold, upside on oil. A bit of a wild ride for traders of oil over the course of this week. Massively higher, sideways, massively lower. Solid move back higher, solid move back lower, then a massive rally in today's session. So slightly a little bit all over the place. High levels of volatility. We need to keep an eye on any escalation from the Middle East. Rumours that Iran may have potentially got involved, they have come out and disputed that. They have denied that. If Iran do get involved and there's fresh sanctions placed upon Iran, well, markets will predict fresh sanctions placed on Iran in terms of oil production and sales of oil. That is a situation where oil will continue to rally. So the longer this conflict goes on in the Middle East, obviously that conflict has been going on a long time, but not to this extent. If it continues to get worse and other countries start to get involved, you'd have to imagine oil continues to push higher. So into next week, a little bit on the side. I will let markets settle down into the close today. have a look on Monday, see how markets open up on Monday morning, and we will be back next week for another week of trading. But have a good weekend. Do rest, or get a bit of rest and relaxation, and do recharge the batteries for hopefully another busy week in financial markets this week. But a volatile week this week. Does it continue on into next week? Let's see how markets open up on Monday morning.